In this session, we are going to deal with the long-term assets and liabilities. So, as such, our focus will be more driven towards the fixed assets, both tangible as well as intangible, and also we are focusing on the liabilities aspect, wherein the major focus I am looking at is with respect to the leases, because they are also in a way related to the long term assets. We will see the benefits of leases over purchases, and how these assets as well as the leasings are considered as a part of the financial statements. How are the financial statements affected because of all the changes and various mechanisms used to deal with the assets, like different depreciation methods or the impairments or revaluations, all these various things that are happening on the assets as well as various leasing methods. How do they impact your financial statement? That is what we are trying to look at in this entire session. So, just to get started into it, the initial thing that we are talking of is capitalization versus expensing. So, any long-term purchase we are making, or any purchase which we are making for the business, it can go either into the P&L statement or income statement as an expense. It can go into the income statement as an expense, or it can go into the balance sheet as an asset. So, if it is going into the P&L statement as an expense, we are calling that particular purchase is expensed. If it is going into the balance sheet as an asset, we are saying that it is capitalized. And so, whenever we are capitalizing it, for that particular cost, we are not treating it as an expense in the P&L statement. So, it is going as an asset in the balance sheet. So, from that perspective, we see that the total assets of the company will grow up, and because expenses are not existing, or for that particular portion which has been treated as an asset, because it's the purchase value, instead of being going as a P&L statement as an expense, we are taking into the balance sheet as a capitalized asset. So, again, this is not applicable to each and every purchase. We'll talk about a few of them, especially long-term purchases which have a useful life of more than 1 year. That is where these kind of situations will come into picture. So, whenever I am capitalizing it, the total assets will grow up, the expenses will come down, right? And because the expenses are coming down, wherever the expenses are down, the net income is planned to go up. And if the net income is going up, this net income is what will go as a retained earnings on the balance sheet into the liabilities and owner's equity section, which means the retained earnings will go up, which means the overall equity will go up. So, these are the ups that are associated with the expansion, the expensing part, capitalizing over the expensing, right? Because if it is capitalized, the expense is decreased in that particular year, which will result in net income going up, retained earnings going up, and even the equity also going up. And when we look at capitalizing, because it's going as a part of the asset, in the cash flow statement, the increase or decrease is treated as the cash flow from investment activities. So, there will be any purchase of an asset will go as decrease in the cash flow from investing activities, but it may not impact the cash flow from operations activities at all. But in case I have expensed that purchase, it would definitely result in bringing down my cash flow from operations. Again, these are very interesting things to consider. If we see the formula of free cash flow to the firm or equity, it focuses more and more on cash flow from operations. And at the same time, let's say if I want to evaluate the quality of earnings of the firm, there also we are looking at cash flow from operations rather than the other two areas. So when I am doing an expensing, I am seeing that the cash flow from operations will be down, but when I am doing a capitalization, it's the cash flow from investments which is down, whereas the cash flow from operations may not change. So this tempts a lot of companies to capitalize large number of purchases so that they can show less in the expenses and probably show more and more net income in the initial years and more retained earnings and probably the equity going up, and at the same time their assets also can typically go up. And at the same time, yes, when I have expensed it, it's a huge expense coming in one single year. But when I have capitalized it, whatever the portion of capitalizing the asset, I will expense it over the remaining few years. Whatever is the purchase, when I am saying I have capitalized it, I have treated it as an asset and I will depreciate it over the life of the asset. So there is a uniformity in the expense every year in the form of depreciation expense, whereas when I am expensing it only in the first year, there is a huge expense and zero expense in the next year, which means the variability of earnings is very, very high when I am treating it as an expense, whereas it is much lesser when I am capitalizing the asset. So that's one more thing that we may have to look at. And in this case, the equity is going up if I am capitalizing it, but the debt does not change. So all the debt to equity ratio or debt to total asset ratio, they all will come down because the debt is not changing, whereas the equity and hence the total assets, all of them are increasing because of capitalization. So one area where we have to be comfortable with is if a company changes its financial statement presentation from a capitalized version to an expensed version or vice versa, I need to know what kind of impact it will create on the various elements in the financial statement, and at the same time I need to know in what way I can convert one form to the other, right? Or also I should be able to understand what could be the motive behind this company switching from one form of presentation to the other form. All these things will play an important role as an analyst looking at the long-term assets as well as liabilities of the company. Now, one more aspect which we observe nowadays heavily in the financial statements is interest that is accumulated during the construction of the asset. So let's say we have a construction period of 3 years and an asset is worth, let's say 3 million. If I am expensing this asset, because only in the 4th year the asset will become useful. So one way is I expense it 3 million in first year itself, or I capitalize it and for the first 3 years I don't incur any expense on it. I capitalize it to the extent of 3 million and after that I depreciate it over the remaining useful life of the asset. So this kind of interest during capitalization period is allowed both under GAAP as well as IFRS. So whenever I am expensing anything, the expenses are much higher, but when I am capitalizing something, obviously the expenses are lesser. So if the interest expense is going less, it is resulting in my total times interest earned, EBIT by I ratio, to directly go up just by changing the accounting mechanism, just by changing to capitalization from expensing part. I am able to increase my coverage ratios also. So that is where the analyst has to be quite comfortable in terms of translating that back to expense and then evaluating or comparing the two financial statements. So even from all these dimensions, it becomes more and more necessary for me to come out with a mechanism of converting one form to the other, so that I can evaluate which all financial statements, and from there which all ratios can be impacted because of this analysis. Then before we get into the conversion part, I would also like to look at a few more areas. See, when we talk about the R&D, should it be capitalized or expensed? It is very clear as per US GAAP, whatever you are incurring as a part of R&D expense, R&D costs, you have to expense it completely. No capitalization of R&D. Whereas when it comes to IFRS, at least you segregate between R and D. You segregate the costs into research costs and development costs separately until the technical feasibility being established. All the costs that are incurred are research costs, and once the technical feasibility is established and you are going forward to develop some kind of piloting or something like that, then you can treat that cost as a development cost. And what it says is that development cost, if you want, you can choose it to capitalize that cost over the life of the asset, but the research cost definitely has to be expensed itself. And one more dimension coming with respect to the assets is the intangible assets that you have generated internally. Sometimes we develop patents, we develop and we file for patent, or copyrights we generate. So in these cases, wherever the assets are generated internally, the only cost for the company is the legal cost. So we are capitalizing only the legal cost. But when the same patents and copyrights are acquired through a purchase of some other company, then they will be included at the acquisition cost itself. Whereas if it is internally generated, then only the legal costs only will be capitalized, because determination of the economic life and separation of the development cost for that particular patent or copyright is a very difficult thing. So as per the law or as per the process, the internally generated patents, you only capitalize the legal costs, whereas when you have acquired them, you can very well capitalize the entire thing. And when you talk of goodwill, internally generated goodwill cannot be depreciated or amortized, whereas when we are, and you cannot even recognize internally generated goodwill, but the goodwill that is acquired through a purchase transaction, through an acquisition transaction, you can very well recognize it, but you need not amortize or depreciate the goodwill, because there is nothing called useful life associated with the goodwill. There could be an impairment of the asset, but there is nothing called depreciation that is associated with the goodwill. Now, let's look at changing the financial statement from one form to the other, which is more like capitalizing versus expensing, and based on that see what is the impact on the financial statements as well as the various ratios and all that stuff. Okay, based on the financial statement that we have, compute the change in ROA and ROE if at all the capitalization is being used instead of expensing the asset. Here, okay, the point that I am trying to consider in this financial statement, the interest during the construction period. Let me rephrase it. Here the point is only the interest during the construction is capitalized. Right now it is expensed. If at all the interest during the construction period is capitalized, what could have happened? And we are saying the construction period is 3 years. Okay, so if I go with that mechanism, okay, accounts receivables will not change, right? I will see account receivables will not change, inventory will not change, current assets will not change. Okay, so all these things will remain the same. Now, the net purchase, we will talk about it, because net property, plant and equipment will get increased by the extent of the capitalization. So right now I am not touching that part. So the total assets will have an impact, and when I am coming to the liabilities and all, I don't think there is any change, right? All these things do not change much, but yes, the retained earnings will definitely change. So the shareholders equity and this part will incur appropriate changes. Now when I am coming to this, right, okay, all these things may not change. Yeah, let's look at it. All these things may not change, because here I have treated interest separately and interest during construction separately. So now that interest during construction also, probably if I'm okay, now let me look at the tax part. Okay, let it be. Okay, now the net income also, let me consider it. So what I am seeing is, because of this transaction, I could see this element will be differing, and because of it, let me compute the tax also separately. So right now this element also will change, and which means the retained earnings will change, the net PPE will change because of the capitalization versus expensing, and finally the cash will change. So these are the various factors that will get impacted between the capitalizing and expensing. Now let's see. Now that this entire 150 I have treated as an expense, right? Even the depreciation I will change. Now that the entire asset or entire interest during construction period, here I have made it 150, whereas in reality now there is nothing called interest during the construction period, so this entry will directly become a 0, whereas this 150 is spread over a 3-year period. So which means the depreciation actually increases by 50. The depreciation can increase by 50 because this 150 is spread over a 3-year period. So instead of showing 150 there, I'll show only 50 in that particular year, because the useful life of the asset is going to be 3 years. So which means the depreciation, either I can show it as along with that, or probably here I don't disturb, and interest during construction itself I show it as 50. Either of the ways, it's only an entry that we need to be comfortable with, right? So probably I can show the interest, or probably I can work out at the interest layer itself. Instead of showing a full amount, I am showing another 50 increase. So whatever is the mechanism we are working out, we just need to be comfortable with that. So the depreciation, I am increasing it by the extent of 50. So now when it comes here, so which means overall the expenses instead of being increased, expenses instead of being 150, they are only 100, which means my profit before tax will actually increase by 100. Let's see what is the profit before tax. The profit before tax in each of the years. Let me create one element here, one row for profit before tax. So this is sales minus the summation of all these things. So the profit before tax is going to be 80 here, and it has gone to be this much, 309, and so probably I'll compute the net income as profit before tax minus the tax. Here also I can say, here I can consider the tax is nothing but profit before tax into 20%, whatever is the effective tax rate. The same logic when I use it here, this is the profit before tax. So the net income will work out as PBT minus the tax. So let me look at it from this standpoint here, and let me use the same logic here also. And okay, from here I can find out what is my profit before tax in each of these years. So directly the profit before tax is working out to 190, means there is an increase of 100 in the profit before tax. And because the profit before tax has increased by 100, the tax will increase by 100 into 1 minus t. So taxes will increase, 100 into t. So the taxes will increase by 20. So resulting in the net income increase by 80. So what all can we generalize here? Okay, the points to generalize when I am converting from expensing to capitalizing, right? The expenses will decrease by whatever is the expensed amount minus whatever is the total expensed amount divided by the useful life. So here we are talking of useful life is 3 years. So 150 minus 150 by 3. So the expense will reduce by 100. So PBT will definitely increase by 100. So the taxes will increase by 100 into T, and net income will increase by 100 minus 100t. So which is 100 into 1 minus t, which is nothing but whatever is the benefit that we are getting multiplied by 1 minus t. Now because there is a net income difference of 80, what I am seeing is the retained earnings now will be increased by this difference in the net income. So this will be increased by the difference in the net income. So the retained earnings should go up by 80, and if the retained earnings are going up by 80, right, the retained earnings are going up by 80, this is what is becoming the total shareholders equity, as well as this is becoming the total liability and the shareholders equity. So based on this, what is coming out is the plant and equipment now, even that has to be increased, right? It has to be increased by 100, because we are out of 150, we have depreciated 50, means the remaining 100 is what we have capitalized. So basically this will get increased by another 100, making it 3072, which means the cash is only the remaining balance. So cash will come out as 4271 minus 3072 minus 1062, or probably I will take it as the summation of these four, which is again the 1062 itself. So which is taking it to 137, which means the cash has actually gone down by 20 by the extent of the cash has gone down by 20 by the extent of the tax that has been paid in this particular year. Now look at for the next year now. Okay, the depreciation is another 50 is being added to the depreciation now, right? So whatever is the depreciation in the current year, because every year 50 is getting added, this year we will treat the depreciation by increase of another 50, so taking it to 189. So which means the retained earnings now will be the previous year retained earnings plus the net income during the period. So the retained earnings have gone up by this much extent, and now the net PPE, the asset is still worth 50 more. Last year it was 100, 50 we have depreciated for this year, so the asset is still worth more by 50. So this is what will become to my PPE, which means now the new cash for me is 162.2, which is what is a decrease of 10. This time the cash got decreased by 10 for the simple reason the cash got decreased by 10 for the simple reason that there was no depreciation expense in the previous year. I mean there is no interest during construction there, but this time we had added the interest during the construction period as a depreciation of 50, which has resulted in an additional cost. So the net income has come down slightly, which has got an impact on the retained earnings and thus the cash. So this is what is the transaction that comes into picture when we convert a cash flow, when we convert a financial statement based on expensing to a capitalization of the asset. So some of the key observations for us: if at all we have capitalized, we see that the assets will go up. A few points. Initially, the total assets are overall the period, the total assets are going up. Some observations I will write. Total assets go up, which we have already observed. And what about the interest? Interest has come down drastically. So especially when I am dealing with the interest during the construction period, the interest has come down, which means interest coverage ratio should go up by the capitalization process. Then what about the profitability now? Look at the profits. In the initial year the profits are higher, whereas in the later years the profits are down. So initial year, so net profit margins or whatever we are looking at, okay, net profit margin is again dependent on the sales. So even if I am looking at, okay, assuming the sales is the same, net profit margin has gone up in the first year, whereas it has gone down in the subsequent years. So obviously we see when I compare capitalizing with respect to expensing, we say that net profit margin will be more in the initial years, but from the subsequent years it typically goes down. And from here, when I look at cash flow from operations versus cash flow from investments, I see the entire capitalizing has increased this part compared to this, which means cash flow from investments has gone down, whereas cash flow from operations is higher in case of capitalizing compared to expensing. And when we look at debt to equity kind of ratios also, if we see, debt did not change in the whole process, but retained earnings have actually gone up. Retained earnings have gone up is an indication that the equity has gone up. So debt to equity, debt to total assets, all these kind of ratios have actually fallen. So once you can visualize this kind of moves across, all kinds of impacts on the financial statements can quite comfortably be evaluated. This is what we need to be comfortable with when we are converting from one form to the other, right? So what all will go up and what all will come down, some of the things that needs to be focused on quite comfortably. The next item to focus as a part of the long-term assets is the concept of depreciation and how the various methods of depreciation will impact the financial statements and ratios. Remember, every aspect that I am looking at as a part of this financial statement analysis, I would see each and every aspect, how is it impacting the financial statements, and from there how will it impact the financial ratios, which can be used by the analyst from the evaluation standpoint. So generally we know that there are different methods of depreciation, and the most common ones being either the straight line depreciation method, wherein I will look at the depreciation expense uniformly over the life of the asset, and that uniformity is simply looked at as whatever is the cost price of the asset, whatever is the purchase price of the asset, minus the salvage value when you sell off the asset on the maturity or after the useful life, the price, the amount that you are going to receive, which is what I call as a salvage value, which means the net usage value, purchase price minus the sale price after the usage, is what we are calling as the total usage value of the asset divided by the useful life, which is telling me that per year what is the amount of useful life of the asset that I am using. Per year what is the value of the overall total useful value of the asset that I am using. That is what is going with a straight line depreciation method. Then, so there the depreciation is uniform over the entire life of the asset. But when we look at a double declining balance method, this is under the category of accelerated method. So in the initial few years we depreciate the asset more, right? In the initial years it gets depreciated much more, and in the later years it gets depreciated lesser, which means the maximum portion of the depreciation happens in the initial years of the usage of the asset itself. That is the reason we call these as accelerated methods. Out of this, double declining balance method is one form where we look at the book value of the asset that is at the beginning of the year multiplied by 2 divided by the useful life of the asset. So if at all the useful life of the asset is 5 years, just to give a quick understanding, if the useful life of the asset is 5 years, as per the straight line depreciation method you will depreciate 20% every year, right? Whereas using the double declining, you do this multiplication by 2 and you depreciate 40% every year. But on the balance, So it means if at all you started with the asset value of 10,000 at the beginning, at the end of the first year you will depreciate 40% of it. So 4,000 will be depreciated and your asset will be left with 6,000. And in the next year, out of this 6,000, 40%, 2,400 will be depreciated and you will be left with an asset value of 3,600. That's how it goes. Right, that is how a double declining balance method works. So it is not on the original cost every year, whereas when we talk about a straight line depreciation method, we look at the original cost of the asset. But a double declining balance, we don't focus on the original cost, we look at the post depreciation value of the asset at the beginning of the year. Whereas the third one, which is the units of production approach, which is again on the same lines as the straight line, but instead of uniformly distributed, instead of the depreciation expense being uniformly depreciated, the numerator will still remain the same, original cost minus the salvage value, but I multiply it with the usage percentage. So I will define some usage percentage. Okay, if I am talking about a vehicle, so the vehicle going for 100,000 miles or kilometers is what is the typical vehicle's lifetime. So in this year, if I have gone for 10,000 kilometers, then I will say the usage of this asset is somewhere around 10% in this year. So it is purely based on the usage rather than an equal distribution over a particular period. Even that method of depreciation is used for those kind of assets which have different usages for different kinds of years. Whatever the mechanism, whatever is the method the company is following, it has to clearly indicate as a part of its accounting practice. And in some cases even we have the MACRS, Modified Accelerated Cost Recovery System. Generally we find for tax reporting purposes this kind of mechanism also being used. So whatever it is, whichever mechanism the company is using, it has to very clearly specify in the financial statements, and we need to understand that the total depreciation over the life of the asset is always constant, right? In no method the total depreciation is higher compared to the other. It's only the allocation over the years that is different, but when I add up for the entire period, I don't see any kind of a difference in the total depreciation. And if at all the company has changed any depreciation method after a certain point in time, from that year onwards, for the asset, for every asset, based on the value at that point in time, the depreciation for the future will be applied. You don't need to apply the depreciation for the past. Whereas from that point onwards, based on whatever is the remaining carrying value of the asset, based on the carrying value of the asset at that point and the revised depreciation percentages at that point, the actual depreciation is computed for the next periods. That is what will happen as a part of the depreciation change in the accounting practice. Now let's look at a simple numerical example. An asset is acquired at 55,000 bucks. Okay, we are saying asset is acquired at 55,000, estimated to have a useful life of 5 years and a salvage value of 5,000. So from here I can find out the straight line depreciation is nothing but the purchase price minus salvage value divided by the useful life. So it's saying 10,000 per year is the depreciation as per the straight line, and it is expected to produce 7%, 14%, 21, 28 and 30 in each of the next 5 years. So as per the units of production method, I am seeing that the depreciation is 7% of the purchase price minus the salvage value. So 50,000 is the purchase price minus the salvage value, so 7% of that. So 3,500 is going to be the depreciation in the first year, 7,000 in the next, 10,500 in the next, and probably 14,000 in the next, and 15,000 in the last. So these are going to be the depreciation. Again, if I add up, everything works out to be the same. 15 plus 14, 29, 39.5 and 10.5, 50,000. So same 50,000 is depreciated, but at different rates in different years based on the usage. And if I am going with a double declining, it's also saying that the double declining will change to straight line after 3 years. So in the initial years, what would be the depreciations? Initially, I have purchased it at 55,000. I will not consider the salvage value in case of double declining at all. So I will start with 55,000 because it's a useful life of 5%, 5 years. Instead of 20%, I will take 40% as the percentage every year, because it's a double declining. So 40% of 55, 22,000 will be the depreciation in the first year outright. So the asset will be 33,000 at the end of the first year. So at the end of the first year, another 40% will take it to 13,300. So 13,300 is depreciated at the end of the second year, for second year. So the asset is becoming 19,800 at the end of 2 years. Another 40% on the top of it is making 7,920 to be depreciated in the third year. So once a 7,920 out of 19,800, if 7,200 is depreciated, it is becoming 12,600 at the end of 3 years. And it is said you change it to straight line over the remaining 2 years. So what is the value that is still left? Now once I am converting it into straight line, I will use the salvage value. So now the salvage value is 5,000. So only 7,600 worth of the asset is still to be depreciated, which means over the next 2 years I will depreciate 3,800 over the next 2 years. Now that I know the depreciations per each of the years using the revenues, now you have the revenues per each of the years, expenses and depreciation. Based on that you can find out the profit before tax or even the net income. Once you know the tax percentage, if at all the tax percentage is given, you can multiply the profit before tax by the tax percentage and arrive at the net income. So all that is needed to understand is how does the depreciation change in each of these mechanisms. All we are observing is in a double declining, a good proportion of the asset is getting depreciated in the initial few years itself, right? Now a few more things. Okay, so some of the things we have already dealt with. If it is accelerated depreciation, we see that the more depreciation is there in the initial years, whereas the depreciation goes down in the later years. So because of that, the net income is much lesser in the initial few years, whereas it increases in the later years. Whereas when we are talking about the cash flows in all these mechanisms, right, in all these mechanisms the cash flow is not changed, because cash flow, there is a cash outflow that has happened in the year of the purchase of the asset itself. But over all these years where the depreciation is applicable, there is no real cash movement. So the cash flow is really not affected. But yes, if the tax difference is there, right? Because if that based on the depreciation method, what we can observe is the based on the depreciation method, your profit before tax could change, and that could lead to a tax difference. And tax difference in a way is nothing but it will impact the cash flow, even the cash. Cash is the only element that gets impacted, and that too it is impacted to the extent of the changes because of the change in the tax mechanism. And sometimes the management plays very effectively in terms of decreasing the depreciation. They try to play with the salvage value of the asset. Once they increase the salvage value, obviously we know that the depreciation will come down, especially when you are using straight line depreciation or units of production kind of a depreciation, or they increase the useful life. Even if the useful life gets increased, because the formulas are original cost minus the salvage value by useful life. If I increase this or increase this, it will result in the depreciation expense coming down and suddenly the profits of the company going up. So as an analyst, we need to observe these kind of handlings, if at all there are any that are done by the company at any point in time. So this is just a summarization of all those things. I think you can easily work out if at all we are using a straight line depreciation versus the other depreciation methods. Yes, the straight line depreciation, if I am using, the depreciation expense is lower, because of which the net income will go up, and because the depreciation expense is lower, the asset is still worth more, and because the net income is higher, the retained earnings will go up, which means the equity will go up. So because of even the net income is going up and equity is going up, so return on assets as well as return on equity also will go up as a part of that transaction. Whereas when we are looking at accelerated methods, we see the opposite. And one more numerical in the same lines. Let's say the initial purchase price of the asset is 50,000 and the useful life was 10 years, and initially I have estimated the salvage value to be 5,000. So as per the straight line depreciation, what should be the depreciation amount of that asset per year? 50,000 minus 5,000 divided by 10. So 4,500 should be depreciated each year. So after 3 years, means after 3 years, probably the depreciation would have already occurred at 13,500. 4,000 per year. So the depreciation should always have, must have already occurred at for an amount of 13,500, which means the carrying value of the asset at the end of 3 years is 50,000 minus 13,500, taking it to 36,500. That is the carrying value at the end of 3 years. Salvage value now is reduced to 2,000. So now when I am modifying the depreciation, I am reducing the salvage value to 2,000, and useful life changed to 8 instead of 10. 3 is already over. So 5 will be more useful life. So my new depreciation is 34,500 divided by 5, which will take me to 6,900 as a depreciation every year. Initially the depreciation was 4,500, but now the revised depreciation for the next 5 years is going to be 6,900. So that's one more way we can play around, or we can work out. In case initially we have estimated something, but over the period we are observing some kind of a differences, we can very well modify the depreciation expense by clearly estimating the useful life as well as the salvage value of the asset accordingly. The next item to focus as far as the assets is concerned is the impairments. Asset impairment. So whenever we use the word impairment, it is reduction in the value of the asset. Reduction in the value of the asset, we are calling it as impairment. So this becomes this has become one of the important considerations both under US GAAP as well as IFRS. So if at all an asset is impaired, what do I need to do? And what is the definition of impairment? These are some of the two things that I need to consider here. So this mechanism of impairment is applicable both to tangible assets as well as intangible assets. So there is no difference between the two. And when I am talking about impairment, first thing I am checking. So for GAAP versus IFRS, there is a difference in what do I mean by impairment. If the carrying value of the asset, what is the carrying value here? Whatever is the original purchase price minus accumulated depreciation, whatever has been depreciated till date. So whatever is left is what I call as a carrying value. So whatever is the carrying value on the books is greater than the recoverable amount. When I say recoverable amount, if I am able to sell the asset today, see, any asset I can do two things out of it. Either I use it or I sell it. So if I am selling it, what is the amount that I am going to get? The selling price minus the cost of selling, whatever is the advertising marketing cost that I am incurring to sell that. So this is what the selling price generally we call as the fair value, the current market price of the asset. So that minus the selling cost is the value of this asset. If I am going to use it, I call it as the useful value of the asset, which is nothing but the present value of the future cash flows. So these I have to expect forecast some kind of cash flows for the future, and discounting them to the present value will give me the value of the asset in use. So out of these, whatever is the greater, so which means I will either use it or sell it. If I am using it or selling it, what is the maximum benefit that I am going to get? So that will be compared with the carrying value, whichever is lower, that is what we represent in the balance sheet for the assets under the IFRS mechanism. And in case the recoverable amount is lesser, we will write the recoverable amount. In case the carrying value is lesser, we will show the carrying value in case of the balance sheet. But when I show the recoverable amount, when I write the recoverable amount, that is where I am calling it as a impairment of the asset. So the difference between these two, the carrying value and the recoverable amount, I am treating it as a loss in the financial statement, loss in the P&L statement to that extent. That is what is a loss because of impairment. And just like in case of inventories, there is a write-up possible to the extent of the loss, which means the gain in the next year. If at all there is, if at all the recoverable amount is more than the carrying value the next year, to the extent of the loss that we have booked in the previous year, I can book it as a gain in the P&L statement, and the remaining excess will go into the balance sheet under the other comprehensive income. So the write-up is allowed under IFRS, but only to the extent of the previous write-down. Then, when it comes to US GAAP, the way we define the impairment is carrying value, if at all, the carrying value definition is still the same. if at all the carrying value is greater than, not the discounted. Here we used recoverable amount, which was using when I say value of asset in use, we were talking of PV of the future cash flows. Whereas in case of US GAAP, when I check carrying value greater than the undiscounted future cash flows, then we say that the asset is impaired, and if it is impaired, I will write it down to the fair value of the asset, and in US GAAP there is nothing called write up, right? So this is what is generally represented under the US GAAP as well as IFRS. So whenever you see that the asset is impaired, it is written down to the fair value. So this is not the undiscounted cash flows. We have to be comfortable here. And whatever is the difference, carrying value minus the fair value, that is booked as a loss in the P&L statement. So that's how we represent the impairment in US GAAP as well as IFRS. So write down component in both the mechanisms, we treat it as a component of income from continuing operations itself. So it is generated quite comfortably. It will affect your net income very well. And once the asset got impaired, this is one important point I generally look at. Once the asset got impaired, the value of the asset actually comes down, which means the depreciation also will come down in the next years, which is a possibility that the net income can go up in the later years because the asset is already depreciated, already impaired, and it has lost its value to a large extent. So obviously the depreciation, which is an allocation of the existing cost, will come down in the later years. So that's where we say the ROA and ROE, though they will be down in the initial years because of the impairment, because the loss will be huge in the initial years because a big expense is recognized. ROA and ROE will be down in the current year, but they will increase in the next years because the depreciation will come down, the assets have already come down, which will result in increasing of the ROA and ROE in the subsequent years. And there is a lot of management discretion going into the impairment process, because once the way the value will significantly differ from company to company. So the analyst has to be very careful as to what is the process the company is following with respect to the impairments, because any big impairment will definitely reduce the value of the asset quite heavily. So just looking at a small calculation here, I am looking at a machine which was bought 6 years ago for 25 million and depreciated on a straight line basis, whose useful life is expected to be 10 years. So basically salvage value was expected to be 5 million. So initial straight line depreciation might have got planned at 25 minus 5 by 10, which is 2 million every year. Fair enough. That has been already 6 years old. So which means the depreciation till date, already 12 million is depreciated. So right now the carrying value of the asset is 13 million, because 25 million, and I am expecting 6 years is already over and every year it has been depreciated by 2 million. So current carrying value is 13 million. Okay, can generate 1.75 million per year in the next 4 years. So undiscounted future cash flows is just 7.5 million, right? And probably even if I am able to sell it off for 2 more million, so the total undiscounted cash flows is only 9.5 million, which means carrying value is greater than the undiscounted future cash flows. So I can very well say that this asset is impaired as per GAAP. And if it is impaired, I will recognize the fair value. I will recognize the fair value as the inventory value as per GAAP. So 7.25, which is the fair value, will be shown as the asset value, and the difference between the two, 13 minus 7.25, 5.75 million, will be booked as a loss in the P&L statement and no subsequent upward revaluation, upward adjustment when I talk about GAAP. And when I am looking at IFRS, the same calculation I will do by discounting it at 6%, assuming the selling costs are 0. So still the market price is going to be 7.25 versus undiscounted cash flows. If I am looking at the present not undiscounted, in case of IFRS I have to consider the present value of the future cash flows. So future is 1.75 million. So I will compute the present value at the rate of 6% for the next 4 years and 1.75 million per year, working out to somewhere around 6.06. Right, the present value of this future cash flows, which is 1.5 million each year for the next 4 years at 6% per year, is going to be equal to only 6.06 million now. So the maximum of either the selling price, which is 7.25, or the value in use, which is 6.06. So I'll compare it with 7. So I'll take 7.25. So even under IFRS, I will book 7.25 as the asset value, and 5.75 million is booked as a loss in the P&L statement. But the only advantage is in IFRS I can recover a gain to the extent of 5.75 million, whereas in US GAAP I cannot recover anything on the upside. That is where the limitation lies. The same thing when I am looking at the revaluation part. Revaluation is of course not allowed in any way under US GAAP, but under the IFRS mechanism the companies have an option to choose the revaluation for all their long-term assets, probably on an annual basis, at periodic interval basis. And if at all there is a gain, they will look at, they have to look at if there was a loss that was booked earlier because of impairment. If at all there was a loss, so that loss will be recovered as a gain to that extent, and any more further gain comes into the other comprehensive income of the balance sheet. Because of the conservative approach, any additional gain because of the revaluation, you don't recognize it as a gain, you bring it into the other comprehensive income of the balance sheet, which is actually treated under the account of revaluation surplus, which will change the other comprehensive income, which means the equity also will get changed. And whenever we are talking of any impairments, so make sure that, because it's more of a management discretion kind of a thing, you look at whether the management has really gone in depth into the process. Have they given some kind of explanation as to why the impairment is considered or why the impairment is not considered? Because it's in the hands of the management, the estimates which they have taken, the salvage value that they have taken, all these things can really have an impact on the carrying value of the asset, which means, or probably even they can play with the other side, whether they may not play with the fair value, but again putting the asset to use. Regarding all these things, they can very well change their estimates and get the values changed. So from an analyst standpoint, there should be a clear-cut evaluation of how this impairment or revaluation has happened, so that there is no question of ambiguity at a later stages. All right. Now let's look at a few things relating to the financial statements, especially with respect to the disclosures. Whatever has been disclosed as a part of the assets, some of the things that are required based on the accumulated depreciation as well as annual depreciation expense, I can very well compute the average age of the asset. Right, the average age simply talks about in how many years I'm on an average replacing the asset. So this talks about my competitive positioning. If I'm taking 30 years to replace the asset, probably I'm working with very old assets which may not be that productive, which means I may not be very much competitive in the market. But at the same time, if I'm replacing the assets where in every 2 years or 3 years, whereas my competition is doing it at an average age of 10 years, then probably I am not utilizing my assets. So though I am going for modernization every period, but it is at a very big expense also. And similarly, it helps me in planning out how much capital expenditure will be required in the remaining years to plan out for the expansions. And apart from the average age of the asset, we also look at average depreciable life. So when I am finding out the average depreciable life, look at the total gross assets and divide by the annual depreciation expense, which will give me the total life which could be applicable to the to the assets. And similarly, if I look at remaining useful life, I am looking at net fixed assets divided by the annual depreciation, which will give me the remaining useful life of the asset. All these things can very well be computed once we look at the details about the accumulated depreciation, annual depreciation expense. Based on these, we can, as an analyst, we can analyze how long will the company take to replace these assets, when is a heavy capital expenditure bound to come into the system. All these things can quite comfortably be understood. Now the next aspect which we are going to look at is the leasing versus the purchasing. How does, see, when I purchase, there is an expense, there is an asset that is getting created. So how do I link that aspect with respect to the leasing, and why do typically companies look at going for leasing instead of purchasing the asset? So sometimes leasing is more and more beneficial from an economic standpoint, because it will reduce the cost of financing. And the more we are, see, let's say we can take a particular asset on a rental basis, which means it is actually reducing the cost of financing. I could use the capital for some other useful purposes, and at the same time, even the risk of obsolescence is reduced. The risk that the asset will go old, or probably it may not be as effective as it was 2 years back, because the technology has changed and today it is outdated. So even those things can be looked at, and it is much better compared to taking a traditional loan. And we can even see that when I am going with an operating lease kind of thing, it does not enter into the balance sheet at all, which means it makes my balance sheet more and more lighter. But in this leasing, we have two different types of leasing. One we call as financial lease or financing lease. In some cases, we even use the word as capital lease. And there is an operating lease. So these two definitions we need to be comfortable with. When we are talking about a financing lease, it is as if we have purchased the asset with a borrowing. So there is hardly much of a difference between financing lease as well as the purchasing of the asset as far as the accounting part is concerned. Whereas when I am treating it as an operating lease, it's more like a rental agreement, getting into a rental process. And in IFRS, when I have to differentiate what kind of purchase or what kind of lease I should treat as a finance lease and what is operating lease, in IFRS, though there is a very straightforward mechanism which talks about a transfer of the title. So wherever the transfer of a title is occurring, we are directly calling it as a financing lease based on the economic substance of the transaction. If I am transferring the ownerships, rights and responsibilities to the other party, we directly classify it as a financing lease, otherwise it goes as an operating lease. But when we talk about from US GAAP standpoint, there are certain requirements, and even if any one of the requirement is met, it gets classified as a finance lease or a capital lease. Either the title transfer or there is a purchase option, a bargain based purchase option at the end of the leasing period. More than that, if at all the lease period right now is for more than 75% of the useful life of the asset, or whatever are the payments that are getting done, if the present value of the lease payments is more than 90% of the total value of the asset, we consider that if any one of these four conditions are met, we consider that kind of a lease as a financing lease itself. And we'll take one example to understand each one of these things, how they impact the financial statements from the lessee and the lessor standpoint. So I'll try to consider a financing lease as well as operating lease from the perspective of lessee, which is the person who has taken the lease, and lessor who has given the lease. How the financial statements will be for each of these four cases, which will clarify the entire aspect for us. But before we put into the financial statement, just a quick understanding of it. What is a financing lease? I am using the debt to purchase the asset. So which means the asset belongs to me now. And once I know that the asset belongs to me, I will increase the asset. And because I have created an asset now, I have to do the depreciation of the asset. And because I have borrowed, the liability increases as a part of the lease payable. So let me look at a simple numerical and try to explain all these things straightforward. Okay, we are talking about an annual lease payment of 20,000 per year for 5 years. So once you pay that, I have got into a lease agreement where it says I pay 20,000 per year for a 5-year period. Okay, assuming that the rate of interest is 8%, compute the entries. Okay, here we are saying you assume it as operating as well as financing, but look at it like this: straight line depreciation, no salvage value at the end of 5 years. Logically speaking, you have used up more than 75% of the useful life of the asset. So logically speaking, it should be considered as a part of the financing lease itself. It cannot be considered as operating lease. But I would like, just for an example purpose, I would like to consider even this as an operating lease also, to show you what entries will come at what point in time. So to address that part, right, I will consider, okay, lease payments. We know we'll make out a kind of a schedule. Okay, right now year 0, which is at this moment. All right, year 1, year 2, year 3, year 4. These are at the end of the years, at the end of year 4 and year 5. Okay, I am considering one, the lease payments. Lease payments at the end of each of the years. There is a cash outflow of 20,000 in each of the years. I am making a lease payment of 20,000 in each of the years. Fair enough. So, how much would I have borrowed? If I pay 20,000 over a 5-year period, if it is saying that my entire lease is getting paid off, whatever I would have borrowed right now is nothing but the present value of all these 5 payments. So I'll find out the present value at the rate of 8% per year for a period of 5 years, wherein 20,000 is the payout every period. It says that I might have taken a loan of 79,854, and because of this, okay, my assets in year 0, right, in year 0, now I'll put assets as well as liabilities. Right now I will increase my assets by 79,854, and also I will increase my liabilities by 79,854. This is under the assumption of a financing lease. And now that my assets have increased by this much extent, and as if I have purchased the asset, and so it is as if that I have purchased this asset at 79,854.2, right? Now what I will consider is, I will consider the depreciation part. Okay, let me do the adjustments a little bit. So because the asset is 79,854, I will apply depreciation as an expense from my side. So the depreciation at the end of each of the years, it's an expense, right? So the depreciation at the end of each of the years is nothing but the asset value by 5. So 15,970 happens to be the depreciation for the next 5 years. So the carrying value at the end of each of the years, or probably I don't need this, I can very well consider the asset value at the end of each period is nothing but after the depreciation for the period. This is what is going to be the value of the asset over the next 5 years, and by the end of 5 years this is going to be 0, because the asset does not have any kind of a salvage value and I am using up a complete part of the asset. Alright, now it looks as if I have borrowed 79,854.2 to purchase that asset, because from the lessee's standpoint, a financing lease is as simple as he has borrowed to purchase the asset. So he has borrowed 79,854. So I can consider the interest and the principal portion, which will give me the balance. So liability balance. So in the first year, or probably the liabilities I already have, right? So I don't need a liability balance. So from here I am computing the interest that I am paying on this at the rate of 8%, right? The interest is 8%, right? Okay, so the interest that I am paying on this is 6,388, whereas when it comes to the principal, it is nothing but 20,000, because I am paying 20,000 every year, but out of that the interest repayment part is only 6,388, which is 8% of my liability that is outstanding. So my principal repayment part is 20,000 minus the interest repayment part, which is 13,611. That 13,000, because I am repaying the principal, my liability will get reduced by that much extent. This is like an amortization schedule, and based on this I can very well do the same thing over the years, which will tell me that at the end of 5 years even my liability is becoming zero. So these are what are my various entries as a part of each of the years. So the total is 20,000 in each of the years. So that is what is my cash flow. Okay, so in reality I am paying 20,000 in each of the years. So the only difference is there is a portion that I am doing to the principal repayment part, and whatever the principal repayment that I am doing, it goes as the cash outflow from financing activities, and whatever the interest repayment I am doing is going as a part of cash flow from operating activities. So that is what is the impact as far as the cash flow statement goes. And now you look at the total expenses in the income statement. What is the total expense? Depreciation is an expense in the income statement, as well as the interest is an expense, right? Okay, the interest also I will not put it from here. Interest I have to put it from here. Okay, interest, let me make the calculation better. Interest I am putting it from here, and even the principal should come out as 20,000 minus this from this year onwards, and the balance should come out, come out from the liabilities at the beginning of the year minus the interest repayment at the end. So let me drag this thing across, right? Even these two formulas I need to update. So this is what is going to be the interest and the principals at each of the years. So from here I can make out that the total expense in each of the years which we are denoting in the P&L statement is the portion of depreciation plus the interest. So in the first year the expense is around 22,000, and what we are seeing is the expense is reducing each of the years. So what we are looking at is the expense. The P&L statement will have higher expenses in the initial years, whereas they keep reducing at the later years, which means the net income will be lower in the initial years compared to the later years. That's one thing. Now if I am looking at the same from an operating lease perspective, so this is as per this is from a lessee's standpoint, if he is going for a financing lease or a capital lease. But if going for an operating lease instead of a financing lease, if we are going for an operating lease, then the expense, which is a rental expense, is exactly 20,000 each of the years, nothing else. No entry in the balance sheet, only the rental expense of 20,000 in each of the years. Now because of that, what is happening is when you have gone for a financing lease in the initial years, your net income is much lesser compared to that of an operating lease, whereas it will be much higher at a later points in time. This is one thing that we have to be comfortable with when we are looking at the difference between the financing lease as well as operating lease. So, and based on this, you can very well identify across the entire 5-year period, you see that the assets are increased at least by some amount, which means assets are increased means any ratios that are dealing with the assets in the denominator, they will go down, and anything which are dealing with the assets in the numerator, they are going to go up. And when we are talking about a cash flow, in this case, in the operating lease case, the entire 20,000 is a cash outflow from operations itself, whereas in this case, only this much is a cash outflow from operations, whereas this much is a cash outflow from financing, which will actually increase my cash flow from operations much higher compared to the method of expensing. So such kind of impacts have to be looked at, because few things, at least assets are higher, means liabilities are also higher, because there is a borrowing process that is involved internally, so the liabilities will go up. And as we have seen in the financing lease, the expenses are higher in the initial few years, which means the net incomes will be lower in the initial few years and slowly they will go up. But when we are talking about the total net income, you see the total expense is 100,000. Here also the total expense is 100,000. It's only the yearly allocation that is different. So the total net income over the period of the asset is going to be the same. And when we are looking at cash flow from operations, we see that it will be higher in case of financing lease compared to that of operating lease, whereas the total cash flow again is going to be the same irrespective of the kind of lease that we are working with. Similarly, you can work out with various ratios, right? The current ratio, because the assets are higher, in a finance lease it should be lesser. And similarly, asset turnover, where sales cost of goods sold or sales by total assets, because the assets are higher, the asset turnover should be lesser. Return on assets, again the same, the assets are higher, so return on assets should be lower. The same logic, return on equity, right? Because the expenses are higher in the initial years, the net income is lower, which means the equity will go down, but at the same time net income is also down. So what we see is overall the overall return on equity also will be lower. All these kind of things can very well be looked at. They can be analyzed quite comfortably once we know that these are the changes that are coming in the financial statements. Now the same logic, if I am going with from a lesser standpoint, actually we have a few more things to consider. Is the lesser going for a sales type lease or a direct financing lease? Especially when we see, okay, here we have seen that the present value of the lease payments is 79,854. Now, if the present if the actual value of the asset, from a lesser standpoint is only 70,000, right? If the value of the asset is only 70,000 from the lesser standpoint, then the entire 9,854 is booked as a gain in the first year itself. This is called as a sales type lease. Though the asset is 70,000 worth, he has sold it for a worth of 79,854 by collecting 20,000 in each of the 5 years. It's as if he has sold it at 79,854, which means the 9,854 can be directly booked as a gain by the lessor in the initial year itself, and from the next years onwards he can look at the interest payment, interest receipts that he is getting. They can add up his interest and the principal receipts that he is getting. They can add up his income statement. When he is talking about direct financing lease, the value of the asset is exactly 79,854, means it is directly purchased and leased at that same price. So in that case, there is no direct booking of the profit in the initial year. We will start looking at only the interest in each of the periods. Now, the same logic, when this much is payable by this person, right? This much is receivable. Now when I look at it from a lessor's standpoint, the same, year 0, I'll try to make this from a lesser standpoint. From a lesser standpoint, in year 0, we call it as lease receivable. He is yet to receive some amount from us. So the lease receivable is to the extent of this much. So depending on the interest, so he is receiving 20,000 every year, which means the interest part, whatever he is receiving, interest he is receiving at the end of the year. So depending on whatever he is receiving in each of the years, he is receiving an interest of 6,300. He is receiving a principal of 13,600 in the first year. So obviously his lease receivable will come down by the extent of this minus this. So overall what I could very well look at is this is what is happening to his lease receivables, which is an asset on the balance sheet. His asset on the balance sheet, which is the lease receivable, is actually getting decreased in each of the periods based on this particular aspect. And what else is happening? The lease, so from his side, he has just given that asset on lease. So only this is the calculation from his standpoint. So whatever is the interest part that he is receiving, it will increase his net income, and but he is actually receiving 20,000. So to that extent, it will reduce his lease receivable. So in this case, his net income is increased by the extent of interest. So which means whatever the interest he is receiving is a cash flow from operations activity, and whatever the principal that he is receiving, it's a reduction in the lease receivable, wherein it is becoming a cash flow from investment activities. Because for him it's like an investment. So whatever he is receiving, it goes as the cash flow from investing activities in his case. And when I am talking about the operating lease, whatever the interest income, right, in case of operating lease, so what will happen in case of operating lease? He is giving the asset on rent to the other party. So he will receive a rental, right? He will receive a rental income which will be 20,000 consistent in each of the years. And because the asset is with him only, a depreciation expense will be applicable to him. Depreciation expense will be applicable to him, which is again equal to the worth of this asset only, which means whatever the income that he is net income, whatever net operating lease income, whatever he is realizing, is to the extent of rental income minus the depreciation. So probably every year he is realizing 4,029 in the form of net income, whereas here he is receiving in the form of interest. So if we look at how much income he is realizing over entire period, in this case he is receiving 20,145 in the form of interest, whereas in this case he is receiving 20,145 itself, which means whatever, whether it is direct financing type, direct financing type lease or the operating lease, in whatever may be the case, the P&L statement over the 5-year period, the income would be more or less the same, but the distribution of the income over each of the years is going to be slightly different in each of the mechanisms. So the same logic applies to cash flow statement also. From his standpoint, when I look at the cash flows, the interest part, whatever he is receiving, I treat it as cash flow from operations inflow, and the principal part I will look at it as cash flow from investment activities. Whereas when I look at the operating lease, the entire 20,000 goes as the cash flow from operations itself. So these 4 statements you need to be comfortable with. How does the leasing affect the financial statements of a lessor as well as a lessee over the period? And one more thing that we have to look at as a part of this particular session is the disclosures requirement. What it is said is, as a part of the disclosures, whatever are the lease payments that are due in the next 5 years, they have to be disclosed year by year. So financing lease as well as operating lease, in the next 5 years, whatever are due, they have to be disclosed, straightforward. Then from 5 to 10 years or whatever, the next after that, you can disclose aggregate. One more thing, and at the same time your liabilities will typically reflect the lease payables, right? It will reflect the lease payables, and what it says is, using the lease payables as the present value and the next few years numbers, you find out the average leasing rate using the IRR mechanism. So you will find out the average leasing rate using the IRR mechanism, which is what we are calling as the interest rate during this period. And one more thing that is suggested is, if at all there are any operating cash flows like this or operating leases, from a calculation standpoint or from a consistency standpoint, it is advised that you convert all these operating leases into the financing leases by considering the present value of all these leases at the IRR rate of return itself. So this is one major thing that is expected from an analyst to maintain the consistency across the different kinds of leases. He can very well go with converting an operating lease into a financing lease and then use it for the comparison purposes. So these are some of the things that you have to be comfortable with when you are analyzing the assets or even the leases. I hope all these calculations are comfortable to you. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or even you can use in an email to send it at vamseder@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.